Hello, I'm Bernard Hickey from interest.co.nz and welcome to an interest rate special, where we bring news that the Reserve Bank of New Zealand has cut the official cash rate to 8% from 8.25%. This is the first cut in the OCR in 5 years and the first time the Reserve Bank has moved that rate in almost a year. Effectively, the Reserve Bank has decided that the economy is slowing so fast, much faster than it expected, even back at the beginning of June, that it needs to give it a boost. So it's cut the interest rates. This was expected by most people in the market. About a 65% chance of a rate cut was built into prices. But still, confirmation of the cut has meant that interest rates, at least on the wholesale markets, have fallen slightly, and the New Zealand dollar has fallen too. It's down to 74.3 US cents in mid-morning trading. That, unfortunately, will bring more inflationary pressure. This is the key question for the Reserve Bank. Could it really have afforded to cut the official cash rate when inflation, even by the Reserve Bank's own measures, is heading towards 5%? And this latest fall in the currency will be a factor. One interesting comment that Alan Bollard made, the Governor of the Reserve Bank, made in his statement when cutting the interest rates was he wanted to reduce the impact of higher international funding costs on New Zealand borrowers, both consumers and businesses. Over the last couple of weeks, the banks have been quietly warning that higher funding costs for the money they borrow from international investors, they would have to pass on in higher interest rates for mortgages and for business borrowing to many people in New Zealand. So what the Reserve Bank has done here is not so much cut interest rates for people on the ground, but actually stopped some of an interest rate increase from coming through. Interestingly, also, Alan Bollard has commented that he expects to cut interest rates again in September. What does this all mean for the economy? Well, typically it takes 18 months to 2 years for any cuts in interest rates or hikes in interest rates to flow through into the real economy. Currently, we're in a recession. It's unlikely this is going to pull us out of a recession anytime soon, particularly when real interest rates, the ones that we pay for our mortgages, that we get on our term deposits, are unlikely to be cut much, particularly for mortgages, and that's going to hurt the housing sector, which already is in a deep slump. I'm Bernard Hickey. That was an interest rate special for interest.co.nz.